Welcome to the deep dive. Today we're getting into L&T Finance, or LTF. Quite a story here about its big corporate makeover. Our sources, they're painting this picture right, that it's potentially a core holding for a growth-oriented portfolio. But, and this is crucial, they're very clear, this is not some passive buy-and-forget kind of stock.
Absolutely not. So our mission today, to really unpack this, it's a high-risk, high-reward situation, and we need to understand why it needs constant watching and, how these big strategic bets might actually play out or not.
And what really stands out, I think, is just the sheer scale of what they're aiming for. LTF is really positioning itself to ride India's huge growth wave, specifically targeting that massive 80 lakh crore gap in MSME and rural credit. That's a market, traditional banks often just don't or can't fully serve. It's vast.
Right. Okay. So let's talk about that strategic pivot. Lakshya 2026, they called it. This was a major shift, wasn't it? Moving completely away from that riskier wholesale and infrastructure lending towards this tech-driven, fully 100% retail model. Fintech at scale. Exactly. And getting there involved a pretty significant deliberate move. That 505 crore net loss back in FY23, that wasn't like a slip up. It was strategic. It was what analysts call the big bath provisioning. They basically aggressively dumped the old wholesale loans, cleaned up the books to make way for this new retail focus without, being dragged down by the past.
A big bath. Okay, so clearing the decks. Sounds intense, but necessary, maybe?
Yeah.
And the results, they look pretty strong on paper. Retailization hit 98%.
Exceeded the target.
And the retail AUM CAGR, that's assets under management growth, was 28%, also beating their goal of 25.
Yeah.
So that suggests the execution of Lakshya 2026 was, pretty much done. Is that how the market sees it, though? Transformation complete?
Well, not quite. Or rather, the focus just shifts. The risk hasn't vanished. It's just changed shape. The real debate now is about the new loan book structure. It's this barbell model. Yeah, balancing, high yield, maybe higher risk segments on one end with safer ones on the other. But here's the catch. 54% of that book, it's still concentrated in more volatile areas. Think microfinance. Farmer finance. That volatility, that's the new cyclical risk everyone's watching.
Okay, 54% is a lot. That feels like a huge chunk exposed to volatility.
Yeah.
So if they're leaning so heavily into these riskier rural segments, their whole plan, the whole investment case, must rely on how they manage that risk, right?
Precisely. That's the entire bull case. It hinges completely on their proprietary AI technology. They've built this AI and machine learning underwriting engine called Project Cyclops. The whole idea is that this tech can figure out the risks in that rural lending space better than traditional methods and, crucially, lower the credit costs structurally.
Project Cyclops. Okay. And is there proof this actually works? Or is it just theory?
No, there's proof of concept. And it's quite compelling, actually. In their two-wheeler loan segment, they tested Cyclops, the result. An 85% reduction in early defaults.
Wow, 85%.
Yeah, it dropped from 2.36% down to just 0.34%. That's huge.
Okay, 85% isn't just tweaking things. That fundamentally changes the risk profile of that segment.
Exactly. It makes a high-risk area potentially very profitable. But, and it's a big but, they have to replicate that success across the entire 54% rural portfolio at scale.
Right. Scaling it is the challenge.
And that lingering question mark is why, LTF's projected return on equity, the ROE, this is around 13.9%. That's quite a bit lower than peers like Bajaj Finance, who are up around, 17.2% ROE?
So that gap tells you something.
It tells you exactly what the market is still worried about. It's pricing in that ongoing risk, that 54% rural volatility. They haven't fully bought into the Cyclops solution yet. And there's another more immediate risk to consider. Looking forward, the company had built up this macro-prudential provision buffer. Think of it like a rainy day fund to absorb shocks. They've been using it quite prudently, actually, to handle things like the MFI stress we saw flare up in Karnataka.
Okay, the safety cushion.
Right. But that cushion is now, it's almost gone. There's only about 125 crore left in it.
125 crore. That sounds low, given the scale.
It is, which means effectively the training wheels are off now.
Right. So what does that mean for investors, for you listening? It means any new significant shot, another MFI issue, a bad monsoon impacting farmer loans, it's going to hit the bottom line directly, the P&L. So expect more near-term earnings volatility, at least until Project Cyclops proves it can work across that whole rural book and keep those credit costs down consistently.
Yeah, the pressure's on Cyclops now.
Okay. But despite that immediate bumpiness, the growth story itself still seems intact. The sources we looked at, they still project a minimum profit after tax CAR-GR, that compound growth rate of 18 to 20%. That's from FY26 all the way out to FY31. So the underlying growth path seems solid.
The growth potential is definitely there, yes. But wrapping it all up, the make or break point. It's hitting their ambitious 3.0% return on assets target, their ROA goal. And achieving that, it comes back entirely to Project Cyclops. Can it really deliver that 85% default reduction or something close across that whole volatile 54% rural portfolio? Can this proprietary tech truly fundamentally smooth out the inherent cyclicality of rural India across the board? That's really the million-dollar question, isn't it? Or maybe the 80 lakh crore question. And it's one you need to keep asking if you're tracking LTF.